Investing is a journey through uncertainty. Prices rise, fall, and sometimes collapse, leaving unprepared investors exposed to losses that can be permanent. Benjamin Graham understood that risk is the one certainty in the markets, and his solution for managing it was both simple and profound: diversification. For Graham, diversification was not optional. It was the first line of defense for any investor who valued capital preservation over speculation. He observed that no amount of research or insight could predict every market movement or company failure. Even careful analysis could not eliminate all risk, but spreading investments across multiple securities could. In essence, diversification is insurance for the investor, a way to weather storms while protecting the foundation of wealth. Imagine the market as a vast ocean. Each investment is a vessel, some large and sturdy, others small and fragile. A storm can sink the fragile boats quickly, but a fleet that is balanced and spread across different waters is far more likely to survive. Graham's insight was that a wise investor builds a portfolio like that fleet: strong, balanced, and resilient. In this video, we will explore Graham's secret to risk management through diversification. We'll trace how his strategies were shaped by historical market turmoil, show why they remain relevant today, and reveal counterintuitive insights that defensive investors often overlook. By the end, you will understand why diversification isn't just a choice, it's the cornerstone of enduring investing success. But the question remains: what did Graham truly mean by risk, and how did diversification become the foundation of his philosophy? That begins with understanding his broader approach to protecting capital. Benjamin Graham defined risk differently than most. To him, risk was not the day-to-day fluctuation of stock prices, but the potential for permanent loss of capital. It was the difference between what you invest and what you could lose if a business falters or a market collapses. Understanding this distinction is crucial for any defensive investor. Diversification, in Graham's view, was the primary safeguard against such risk. No investor, no matter how skilled, could foresee every economic twist or corporate failure. By spreading investments across multiple companies and industries, the defensive investor reduces exposure to any single catastrophe. Graham emphasized that diversification does not eliminate risk entirely, but it manages it intelligently, ensuring that losses in one area can be offset by stability or gains in another. He also cautioned against relying solely on analysis of individual securities. Even a company that appears strong on paper may encounter unforeseen challenges: market shifts, management errors, or regulatory changes. A portfolio concentrated in a few sure bets magnifies the danger of these uncertainties. Graham's solution was both elegant and practical: balance, breadth, and prudence. Furthermore, diversification is as much psychological as it is financial. Knowing that your wealth is not tied to a single company or sector allows you to remain disciplined during turbulent times. Panic is less likely to dictate decisions, and rational judgment can guide investment actions. In essence, Graham's philosophy links risk perception, capital preservation, and human psychology. He understood that successful investing is not about eliminating all risk, an impossible goal, but about structuring a portfolio so that volatility becomes manageable and losses are contained. To fully appreciate why Graham prioritized diversification, we need to look at the historical market turmoil that shaped his thinking. The 1920s were a time of exuberance in the stock market. Prices soared, fortunes were made seemingly overnight, and investors were caught up in the excitement of easy gains. Graham witnessed this fervor firsthand and understood the dangers of overconfidence and concentrated holdings.
Then came the crash of 1929, followed by the Great Depression. Entire industries collapsed, banks failed, and millions of investors saw their life savings evaporate. Those who had placed all their capital in a handful of stocks or even in single sectors suffered catastrophic losses. Conversely, investors who had spread their investments across multiple companies, industries, and bonds were far better positioned to survive. Their portfolios were not immune to loss, but the damage was contained and recovery was possible. Graham studied these events carefully. He observed that the market punishes both ignorance and overconfidence. Concentrated investments, no matter how promising, can become traps when economic conditions shift. He realized that protecting capital through diversification was not merely prudent, it was essential. This historical context illustrates a timeless truth. Volatility is inevitable, and speculative excitement often masks underlying risk. By diversifying, investors create a buffer against unforeseen shocks, allowing them to navigate turbulent periods without panic or irreversible loss. The lessons from Graham's era formed the foundation for his core principles on diversification, which we explore next. Graham's approach to diversification is grounded in practical, actionable principles rather than abstract theory. First and foremost, he recommended spreading investments across multiple industries and companies. The goal is to reduce exposure to any single company's failure or sector downturn. By doing so, losses in one area can be offset by stability or gains elsewhere. Next, he emphasized balancing asset types. A defensive investor's portfolio should include not just stocks, but also bonds or other low-volatility instruments. Bonds act as a stabilizing force, providing predictable income and mitigating the impact of equity market swings. Graham viewed this balance as essential to managing risk and preserving capital. Another principle is quality over quantity. Diversification does not mean owning dozens of random stocks. It means selecting financially sound companies with strong balance sheets, consistent earnings, and reliable dividends. Spreading investments across poor-quality companies does little to reduce risk. Instead, it compounds it. Graham also advised periodic portfolio review and adjustment. Markets evolve, and a company that once fit defensive criteria may later face new risks. Regular reassessment ensures the portfolio remains diversified and aligned with the investor's risk tolerance. Ultimately, these principles are about intentional protection. Diversification is not a passive strategy or a hedge against all losses. It is a deliberate, disciplined framework that allows investors to pursue growth while shielding themselves from catastrophic declines. With these principles in mind, the next question is how to construct a defensive portfolio that embodies them. Constructing a defensive portfolio requires more than just spreading investments randomly. Graham emphasized thoughtful composition, blending stability with growth while maintaining resilience against market swings. A classic defensive portfolio balances stocks and bonds. Stocks provide potential growth, but only if carefully selected for financial strength and reliability. Bonds serve as a stabilizing anchor, offering predictable income and protecting the portfolio when equity markets experience turbulence. Graham viewed this balance as essential to managing risk and preserving capital. Within the stock portion, quality matters more than quantity. Defensive investors focus on companies with consistent earnings, strong balance sheets, moderate debt, and a history of reliable dividends. These attributes indicate resilience and the ability to endure economic downturns. It is not enough to simply diversify across industries. Each security must be fundamentally sound. Diversification also extends beyond individual companies. Different sectors and industries respond differently to economic cycles. Combining holdings in consumer staples, utilities, industrials, and other areas ensures that market turbulence in one sector does not jeopardize the entire portfolio. Finally, Graham advised periodic rebalancing. Over time, some investments will grow faster than others, potentially altering the portfolio's risk profile. Regular adjustment restores balance, reinforces diversification, and keeps the defensive investor aligned with long-term objectives.
A well-composed portfolio sets the stage for understanding how intrinsic value and margin of safety work hand in hand with diversification. Diversification alone is not a shield against losses if the underlying investments are overvalued or fundamentally weak. Graham paired his emphasis on spreading risk with the concept of intrinsic value, the true worth of a company based on its assets, earnings, and long-term prospects. Even the most diversified portfolio can suffer if all holdings are overpriced or poorly managed. By analyzing intrinsic value, the defensive investor ensures that each investment has a margin of safety. This margin acts as a cushion against unforeseen events, errors in judgment, or temporary market downturns. Diversification and margin of safety work together. Diversification reduces the impact of individual failures, while intrinsic value analysis ensures that each component has solid fundamentals. Historical examples from Graham's era illustrate this principle vividly. During the Great Depression, some companies appeared attractive on the surface, low prices, high yields, but underlying weaknesses led to collapse. Conversely, firms with sound assets and sustainable earnings weathered the storm, even when market prices temporarily dipped. Diversification ensured that the portfolio's losses were limited, while a focus on intrinsic value prevented catastrophic missteps. Today, the lesson remains equally relevant. Even in modern markets filled with fast-moving trends and high-flying sectors, pairing diversification with careful assessment of intrinsic value helps investors mitigate risk while identifying opportunity. It is not diversification alone, but disciplined diversification rooted in quality that safeguards wealth. Yet even the strongest portfolio is tested by market volatility, which brings us to understanding how diversification protects both capital and the investor's psychology. Markets are inherently volatile. Prices swing daily, sometimes dramatically, driven by economic data, geopolitical events, or simply investor sentiment. Graham recognized that this volatility is not merely a financial challenge, it is a psychological one. Panic and greed often drive irrational decisions, causing investors to buy high and sell low, the exact opposite of disciplined strategy. Diversification provides a psychological safety net. Knowing that your investments are spread across sound companies and industries allows you to withstand short-term shocks without panic. It reduces the fear that a single bad decision or an unexpected event will destroy your portfolio. This mental reassurance is critical for maintaining discipline and sticking to long-term plans. Historical context reinforces this idea. During the market crash of 1929, investors with concentrated holdings often succumbed to panic, selling at massive losses. In contrast, those who held diversified portfolios remained more rational, absorbing shocks without permanent damage. Graham understood that protecting the mind is as important as protecting the wallet. In modern times, rapid news cycles, social media, and instant trading amplify emotional reactions. Diversification allows the defensive investor to ignore the noise, maintain perspective, and resist impulsive behavior. It reinforces patience, discipline, and rationality, the hallmarks of successful investing. With psychological stability established, the defensive investor can appreciate some counterintuitive lessons about diversification that even experienced investors often overlook. While most investors understand diversification superficially, Graham offered subtle, counterintuitive insights that distinguish disciplined investing from guesswork. First, he emphasized that diversification is not about owning every stock in the market. Spreading investments too thinly dilutes returns and can obscure focus on quality. Thoughtful, selective diversification across strong companies and industries is far more effective. Second, Graham highlighted that over-diversification can be as dangerous as under-diversification. A portfolio with hundreds of mediocre or speculative stocks may feel diversified, but it still carries significant risk if each component is unstable. The goal is balanced risk exposure, not sheer quantity. Another insight is that diversification does not eliminate volatility, it manages its impact. Even a well-diversified portfolio will experience ups and downs, but the fluctuations are less severe and losses are contained. This stability allows investors to maintain composure and act rationally rather than emotionally.
Finally, Graham suggested that diversification is as much strategic as protective. Properly applied, it creates opportunity, enabling investors to take advantage of temporary mispricings without over-concentration in a single sector or stock. It is a framework that allows both security and flexibility, a balance that is rare but critical in successful long-term investing. With these insights, the defensive investor gains a deeper understanding of how to construct a portfolio that withstands volatility while capturing growth, which brings us to applying these principles in today's markets. Though Graham developed his strategies nearly a century ago, their relevance remains undiminished. Modern markets are faster, more interconnected, and filled with complex instruments. Yet the core challenge of risk management is unchanged. Diversification continues to be the primary tool for defensive investors. Applying Graham's principles today begins with assessing risk tolerance. Every investor has a different capacity for loss, which guides the allocation between stocks, bonds, and other assets. The more conservative the investor, the greater the emphasis on stability and fixed income. The more aggressive, the higher the allocation to carefully selected equities. Stock selection remains rooted in quality. Companies should demonstrate consistent earnings, strong cash flow, manageable debt, and a track record of dividends. Diversification across industries further reduces vulnerability to sector-specific downturns. Bonds, cash equivalents, or low-volatility funds provide stability and income, reinforcing the defensive structure of the portfolio. Modern technology amplifies the need for diversification. Algorithm-driven trading, social media hype, and rapid news cycles can create sudden, intense market swings. A diversified portfolio buffers these shocks, allowing investors to remain calm and rational. Graham's timeless guidance is clear. Prepare for uncertainty, protect capital, and resist the urge to chase trends or concentrate holdings. By applying these principles consistently, investors today can navigate volatility, maintain psychological composure, and achieve steady, long-term growth, all while following the enduring wisdom of Benjamin Graham. The final step is understanding how all these lessons tie together, forming a comprehensive approach to defensive investing. Benjamin Graham's insights into diversification remain as vital today as they were during the tumultuous markets of the 1930s. He taught that risk cannot be eliminated, but it can be managed intelligently. By spreading investments across sound companies, industries, and asset types, investors protect their capital and maintain the ability to participate in long-term growth. Diversification is more than a defensive measure. It is a framework for rational investing. It encourages patience, discipline, and perspective, preventing emotional reactions to short-term market turbulence. A diversified portfolio, constructed thoughtfully with high-quality holdings and balanced asset allocation, reduces the likelihood of catastrophic loss while providing a foundation for steady returns.
Graham also showed that diversification must be strategic, not mechanical. It is not about owning dozens of random stocks, but selecting resilient, financially strong companies across sectors. It is about pairing protection with opportunity, creating a portfolio that can endure shocks and capture value over time. In today's fast-paced markets, where social media, speculation, and algorithm-driven trading can create sudden swings, these lessons are more relevant than ever. Investors who follow Graham's principles, combining diversification with intrinsic value analysis, margin of safety, and disciplined portfolio management, can navigate volatility with confidence. Ultimately, diversification is not optional. It is the cornerstone of risk management, the shield that protects wealth, and the strategy that allows defensive investors to endure and prosper across decades. Graham's wisdom teaches us that thoughtful preparation, rational decision-making, and patient execution will always triumph over fear, hype, and short-term chaos. Markets may change, technologies may evolve, and trends may come and go. But the principles of diversification and risk management endure, timeless as Graham himself.